legally required to pay back money that doesn't exist yet. Not metaphorically, literally. When you signed your mortgage, the bank didn't hand over money it had saved up. It typed a number into a computer and your loan came into existence. Right then, out of nothing. And now you owe it back with interest. Which means the interest has to come from somewhere else, from someone else's loan, which means they need to borrow, which means someone else needs to borrow after them. And on it goes. The entire Australian economy depends on that borrowing never stopping. $3.33 trillion of household debt. And if Australians ever collectively decided to pay it down and stop borrowing, 2008, the global financial system nearly ended. And the people who understand that would prefer that you didn't ask. If money's created as debt, who benefits from you staying in it? Well, it turns out the Bank of England answered that in 2014, in black and white, in a paper most people have never even heard of. Here's what most of us were taught. Banks take in deposits. People save their money. The bank holds it. And when someone needs a loan, the bank lends out what it's collected. Simple, sensible. The bank's like a middleman, moving money from people who have it to people who need it. That's the version in the textbooks. And that's the version most people believe their whole lives. I fell for it too. Turns out, it's completely wrong. The Bank of England confirmed in 2014 that when a commercial bank approves your loan, it doesn't lend out money that was already sitting somewhere. It creates a new deposit in your account. The money comes into existence the moment the loan has been approved, and it's destroyed when you pay it back. Hang on. So the bank didn't have the money before you asked for it. It typed a number into a computer and the money appeared. And now you owe it back with interest. Which means most of the money circulating in the economy right now exists because someone took out a loan. Your mortgage, a business loan, a car loan, a credit card. That's literally where the money supply comes from. The system doesn't just allow more debt, it needs it. Not because someone designed it to be predatory, because of how money is created and destroyed. Now add interest, and this is where it's not so pretty. Say the bank lends you $100. Simple enough. It creates the principal, the $100, but it doesn't create the interest, the $105 you need to pay back. That extra $5 has to come from money already in the system, which means other people have to have it, which means they got it because someone else borrowed it into existence, which means the total debt in the system has to keep growing just to cover the interest on the debt that already exists. Now, some people will take that and run with it. They'll say the whole thing's mathematically guaranteed to collapse. The interest banks collect doesn't just vanish. It flows back out as wages, dividends, operating costs. So that's a stronger claim than the evidence supports. The same dollars get spent and re-earned many times over. So this isn't about the interest being impossible to pay. It's about what happens when borrowing slows down and less money is flowing. The system is wired toward more debt, always. And when the borrowing stops, you get 2008. Not a theory, it's all there in black and white. 2008. Globally, banks stopped lending to each other. Full stop. The money simply stopped moving. Governments and central banks stepped in at a scale never seen before. Central banks across the US, Europe, and the UK created new money and pumped it into the system. They called it quantitative easing, which is just a technical name for printing money to replace what the private lending machine had stopped producing. Here in Australia, the Rudd government rolled out one of the biggest stimulus packages in the nation's history. 67 billion all up. Cash payments to households, infrastructure spending, all of it designed to keep money moving through an economy where the private credit machine had stopped. Economists still argue about how much of the save was the stimulus versus the mining boom. But the scale of the response tells you everything about how fragile the system had become. Banks stop lending. The economy slams the brakes on. The government and central bank step in with emergency money creation. That sequence happened 12 years before COVID, which then ran the exact same pattern. The system doesn't just need more debt, it completely falls apart without it. I spent over a decade as a mortgage broker. I sat across the table from hundreds of clients during that time. Not irresponsible people, not people blowing money on things that they simply didn't need. People just trying to buy somewhere to live, pay back that loan, and keep their households running. And the pressure on them, that wasn't accidental. Australian households owe around 177% of their disposable income. That's the RBA's own measure. Put it this way, if an Australian household earns $100,000 a year, they owe about $177,000 on top of that, among the highest in the developed world. And here's the thing about Australia specifically. Around 95% of our mortgages are variable rate. That means there's no fixed price on your loan. When the Reserve Bank changes the interest rate, your repayments go up or down within months. In the US, most people lock in for 30 years and never feel it. Here, when the Reserve Bank moves the cash rate, it lands on your kitchen table within months. I watched inflation rise. I watched the RBA raise rates. I watched those rates hit my clients' repayments month after month. The system runs on debt. Not your debt specifically, but somebody's, always, and it's growing. When the borrowing stops, the whole thing breaks. That's not an accident, that's the design. This isn't new information. Societies have known about this problem for thousands of years. Some of them built a solution directly into the system. Ancient Mesopotamia, Babylon, the same civilizations that gave us the first written records of credit and debt. They also built something the modern financial systems got no equivalent of. They built in a reset, then someone removed it. All right, let's run this through the pub test. Recap. None of this is secret. The Bank of England put it in black and white in 2014. The evidence has literally been sitting there. It's just not front page news. 3,000 years ago, people understood this problem well enough to build a structural solution into their economic systems. The modern financial system simply has no equivalent. The system is wired toward more debt, always more. Australia's carrying household debt at around 177% of disposable income. Around 95% of our mortgages move the moment the Reserve Bank does. And the people who built it that way have got absolutely no incentive to change it. So I'm giving it 1 beer out of 5. Why? Because the system works exactly as designed, just not for us. So what's your rating? How many beers do you give it and why? Let me know in the comments. I'll catch you in the next one. Cheers.